Okay, good evening, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there. Just to let me know that it is indeed working. Want to welcome everybody here. Also want to give a shout out to those of you watching this in the recording. I want to say hello to all of you guys watching this on YouTube. But like I said, just want to welcome everybody here. I'm excited to host this webinar. This is one of my favorite webinars that I host every week. We do a specialty webinar every Wednesday night at 8 p.m. Eastern. Tonight, twice a month, we do overnight trading and sentiment labs. So tonight is overnight trading and of course sentiment. Last week we talked about EAs and copy traders. Next week we will talk about how to pass a prop firm challenge. So um, if you guys have prop firms that you guys are interested in, uh, then send me those prop firms throughout this next week, and I'll get them added to the slideshow for next week. So that'll be good. But I'm excited. I've prepared a little bit tonight. I want to show you guys a couple of overnight trading methods that I've kind of put together over time. 2 weeks ago, I shared my the London breakout strategy, which was pretty awesome. Tonight, what we're going to do is I'm going to show you how I do these what we call modified martingale. It's a pretty unique way to make these. I actually used it on the Aussie dollar last night. Um, I'll actually show you guys some of the trades that I took. But the modified martingale, I'll show you when to use it, how to use it with overnight trading. It'll be really nice. And then, of course, we'll talk about sentiment as well and how sentiment works. So do that. And then right after this webinar, we actually have our call on the COT report. So that will be right after this at the top of the hour. So looking forward to that as well. So I think this will be really good. But before we get started and jump into the live discussion and going over the details of the strategies and the particulars that way, I got to make sure that we go over our disclaimer. So as always, I need to remind you guys about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys, well, let's go ahead and get started. So I was trying to think about where I want to start. I think I will start with the overnight trading stuff, and then if we have time, like I said, we'll kind of get into the sentiment side of things. But wanted to show you how to use this technique. So first of all, I want to explain how I do this. So a lot of people come to me and they say, "Hey, Steve, I like these weekly trades that you take, but they're super passive and I'd like to be a little bit more active." And they say to me like, "Hey, I'd like to be more engaged with what I do in the markets." And so, they want to be taking trades more often. This is for somebody who maybe has a little more time on their hands. But it's also something that you can do it's not something that you have to be glued to your computer screen on, but it allows you to do something during the week, right? So a lot of people like this what we call modified martingale technique with some of these overnight trades. So what do I do with this? So and let me explain what it is before I answer that question. So um, trying to think of where to start with this. So basically, one of the things that's really important when we're trading, when it comes to risk management, is that we get bigger wins than our losers, right? Like our losers need to be small, and our winners need to be bigger. Okay. When I talk to investors and I talk to people all the time, they say, "Hey, Steve, what's your win rate? What's your win rate?" And win rate is a really important metric, right? Because the win rate tells people how often your system or your robot or whatever it is that you're using, how often does it take winning trades? And then conversely, how often does it take losing trades, right? So we want to know that number, and it's a very important number. But I feel like the number that a lot of people don't ask that they should be asking for is what is the average win to average loss, right? So this comes down to your risk to reward ratio. Um, so there are people out there, and in fact, a lot of the really good traders that I know of actually have a losing win rate. So they lose more than half their trades, but their average win is so much bigger than their average loser, right? And so this is kind of, you have to kind of decide when you begin trading, like what is the win rate that makes sense, uh, and the average win to average loss ratio that makes sense for what you're doing. So you kind of have to have a feel for your market, your risk appetite, all these different variables. You kind of have to have a feel for that before you decide what you're going to attempt to do. Okay. So the reason why I bring that up to preface the modified martingale is because I use the modified martingale to make my winning trades pop even more. Okay. And I use it as a way to recover losing trades in a very specified way. Okay. So let me explain how this works. So let me give you an example. So I used this last night on the Aussie dollar. So I took a couple of personal trades on this pair. I use the modified martingale. And the way it works is, in fact, before I even show you what I did here, let me just go to a blank canvas up here so I can kind of draw it out. So let's say you find something from the scanner, like like the Aussie dollar this week, or like the Aussie CAD or the Aussie franc. All of those were good buys this week. Or um, we could even use the pound dollar because that was a weekly trade. Obviously that trade didn't go in the right direction because we did a short, and that was, like not a good trade this week. So and I could show you how that would work, how you would use the modified martingale on something like that. Um, but you're gonna love this. So like bear with me as I explain it because all of the pieces are gonna come together as you see what we're doing with this. So basically, let's just kind of draw out some kind of market. And I'm just going to draw some ups and some downs. And then let's just pretend that this is, like I said, the Aussie dollar. And let's say that you want to buy this currency pair. Okay, so let's just say that this is like Sunday right here. Okay, that vertical line. And what you're going to do is you're going to come into the market, on an evening or whenever you have time. I usually recommend that uh, if you're going to use the modified martingale technique, that you set aside a very specific time each day that you can come into the market to adjust. Okay, so I usually do this in the evenings for me. Um, just seems to work. If you're a morning person, then just do it in the mornings. But just make sure that you can do this once a day. And you're going to see why you need to be able to do this once a day. So it's a little bit more of a hands-on approach. But what you're going to do with this is you got to find a currency pair that you already believe is going to go up or down. Okay, with this one, we talked about this at the beginning of the week. I posted on Telegram that I thought that this pair was going to go up from the COT data, and anyway, you guys already know we talked about that. So you have to find something that you believe is going to go up or down inherently first, okay? Then what you got to do is you just take an initial trade, right? You have to decide, okay, like I'm just going to get in that market. So let's say that we're just going to call this a buy market, okay? And you're just going to get in right away. Then what I do is I actually place a series of buy stops in the direction that I want to go. And I separate these. I usually separate these about a half an average daily range apart. So you can find this on the scanner. So if you actually go to Steve's scanner, you can see what the average daily range is for each currency pair. And why do we use the average daily range? So the average daily range is actually really helpful for a lot of strategies because this gives you a sense of how far a currency pair goes up or goes down in a particular day. Okay, so like when we say average daily range, the range of how far a currency from its top of the day to the bottom of the day, that's the range. Okay. And we use it for it's a weekly stop loss. We use it for other things. I use it for the modified martingale. So if I'm trading the Aussie dollar, I'm going to look at this and be like, okay, the average daily range for the Aussie dollar here, you can see is about 61. Maybe you can't really see that. I can barely see it. So if I can barely see it, it's probably hard for you guys to see through a screen recording. But it says 61 right there. So that's the average daily range. So I use about half that. So we'll say like 30 or 31 pips is the half an average daily range. So what I would do is I would come back here and on that same night, so let's say this is Sunday night and I'm starting up a new overnight trading uh, uh, modified martingale technique setup. What I would do is I would come in here right after I take the buy market trade Immediately after, I'm going to place an equivalent trade about 31 pips above it. So it's a pending order. It's a buy stop specifically. And oh, I almost got that spot on. Yeah, that's it right there, like 30, 31 pips right there. And then this is going to be I'm going to type this out. This is going to be a buy stop order. Okay.
Hey traders, it's Steve from the future. I hope you have enjoyed this video so far. If you are getting value out of this video, be sure to hit the like button, click the subscribe button, and share your trading thoughts. I read all the comments, so feel free to ask any questions you have there too. On a side note, I host live trading calls like this one you are watching every day. Some of my biggest trading secrets I share exclusively to just the members in my program. I host these live trading calls every day, Monday through Friday at 11 a.m. Eastern. I also host a basic training webinar every Monday for the newer traders and the regular COT report and sentiment trading webinars every Wednesday night at 8 and 9 p.m. Eastern for the advanced and aspiring traders. All of these calls are recorded and promptly posted on the members' trading calendars at the conclusion of each call in case your schedule does not permit you to come to the live call. All of my members have complete access to the scanner. We call it Steve Scanner. This is an institutional grade trade alert scanner that picks the direction of the week on all 28 major currency pairs and includes trading instruments like gold, silver, NAS 100, US 30. Just in the last 90 days, I have made over 3,000 pips just taking the top trade signals from the scanner at the beginning of the week and then just holding those trade alerts until Friday. If you want access to the scanner, you can start a 14-day free trial with the join link in the description to get started. Lastly, if you really want to be a full-fledged VIP member of my program to get access to things like the basic training course, live signals channel, Steve's scanner, trading calendars, and the one-on-one calls with me throughout the month, you can use code YouTube50, that's YouTube50, no spaces at checkout, and save $50 on your first month. Again, just click the link in the description below and apply that coupon to become a VIP member, and I look forward to helping you with your inevitable trading success going forward. Now, back to the video.
You guys are going to love this. So hang on. Hopefully this is making sense so far. You're going to see this come click together because this is seriously one of the coolest things I've done. I've actually passed several prop firm challenges doing just this exact thing. And I'll show you how to manage risk with it and everything. It's really important that you do that. So I'll show you what I do with this. So first of all, okay, so we placed the market order. That same night, you're placing another buy stop. Then what I do is I immediately after I do that, I do another one. Okay, so I do three. I have a total of 3 orders. Okay, I'll place another buy stop. Okay, actually, let me delete that. I'm just gonna copy this. There we go. Perfect. So we got a buy stop, another buy stop, about 30 pips off that. Okay. So I usually place at least 2 trades above that. You could place a third one if you want to. And the idea here is that the reason why we're placing these buy stops is if we're right about this trade, then we're going to gradually increase the stakes as this goes in our favor. Let me ask you guys a question. What does the average retail trader do when the market goes against them? Does the average retail trader add to the trade, or do they close it? I'll answer, but you guys can also answer as well in the chat box if you guys are thinking of it. But the average trader is if they get into a buy position, yeah, you got it, Roger. That's exactly what they do. They add or hedge. Exactly. Sean, correct. You guys both got it. So if like, let's say you buy right there and the market went down, the average trader is going to add to that trade. Why do they do that? Why do we add? I'm not saying we do this, but like, why does the average retail trader, the average Joe who trades Forex, why does he or she buy when the market goes down against them? Because they view it as a discount. The idea is if you buy into something and you buy at a lower price, if the market does in fact go back up, you recover all that you lost plus more. Okay, so that's the hope that people have. Now in Forex, in my opinion, it's one of the worst things. It sometimes pays off, but I think if you get in the habit of I think if you get in the habit of adding to a loser constantly, you will eventually blow up your account. Okay, you're going to get yourself into a heap of trouble and you can lose a lot of money, right? So I'm not a big fan of adding to losers. And you'll see that here in just a moment because in fact we are trying to add to the winning trades. Okay, it's all going to come together. You guys are going to love this. So that's what we don't do is like I'm not going to place a buy limit down here. That's not the prescription. Like we are not going to add if the market goes down. We are in fact going to add if it goes up. So let's do a couple of scenarios here. So now let's let's let this go. So this is Sunday night right here. We're gonna let this thing play out here. So let's say the market now, um, we're gonna go to bed. It's Sunday night. We've got this all set up, and then let's do scenario one. Let's say that this just does what we want it to do. So let's say you wake up the next morning, it's Monday, and the market's now up here. Well, that's perfect because we were hoping to buy. We already bought originally. We had a buy market trade right here. And then while we were sleeping, the buy stop triggered and we're now in another buy. And then the second buy stop triggered. So now we're in three buys and they're all making money. Okay. That's the perfect scenario, right? Like that's what you want to happen. And you want this to happen by, hopefully by the end of the week, it just keeps going in that direction and you're sitting really happy. Okay. That's scenario one, because now you've got three trades making you money and you're doing great things. Okay. Now let me give you another scenario. Let's say the next day, um, you wake up, this is Sunday, you have everything set up, and let's just say you go to bed and immediately as you go to bed and throughout the night, this just goes down. Okay. So it goes down, you're in one trade. What do we do? So now it's Monday night. Okay, so let's put another line here. Let's put a line like right here and say that this is Monday. Okay. And now we're down here. Okay, that stinks. We're down only on one trade. Okay. We're down on one trade right here. But we're not in these buy stops. Okay, that I'm going to give you that scenario where things go wrong here. I'm going to give you all scenarios here, but we're just going to start with this one. So let's just say I showed you the ideal scenario before. The ideal scenario is everything just goes in your favor and it's a perfect world, right? And sometimes that perfect world happens. So I know a lot of times we're pessimistic about things because you have to be in this market, but sometimes the perfect world does happen, and that's an easy world to live in. Now, let's say the not as perfect, not as ideal world comes along, which happens often, right? So what do we do with that? So let's say the market comes down to here, and you're in fact losing on this trade. Okay, what we do is we don't panic, number one, right? And what we do is if so long as the COT data and everything else we're following still says to buy, we stay to our conviction, but we got to do this the right way. Like we don't want to over leverage ourselves and get ourselves into trouble, right? So how do we do this? How do we recover this trade appropriately? So what I do is I say, okay, here's Monday, we're down here and this went the wrong direction. So now I'm going to readjust. So this is what the overnight trading concept is all about. I'm going to come here and I'm going to take this old buy stop that never triggered and I'm going to move this down. Okay. And I'm going to move it 30 pips off of the current price on Monday night. So if Monday is right here, I'm going to move this up to like, yeah, I almost have it spot on, just about right there. So I'm going to put the buy stop now 30 pips above the price on Monday. Then what I'm going to do is I'm going to grab this old buy stop, the last buy stop, and I'm going to put it 30 pips above that one. Okay. So about 30 pips. That's almost perfect. Just a little bit lower, about right there. And I'm going to move this back right here. So now I'm ready to go for Monday. So on Monday night, we readjust. We've now moved those two buy stops down. They're not triggered yet. They've just been adjusted. And we're in this buy market trade that is currently it's a singular trade that is down. Now let's say Tuesday rolls around, we go to bed, and the market goes up now. Okay. Well, that's perfect because while we're sleeping, we recovered the buy trade and we subsequently triggered into these buy stops as the market started to go back up again. Now we're really happy because we never had a really big drawdown because we only were in one trade that was down. Now we're in three trades that are now positive. Okay. That is a really good spot to be in right there. Really good spot to be. Okay. Now, let me give you another scenario. Let's actually say instead, Tuesday rolls around and the market actually continues lower. Okay. So now we get to Wednesday. Okay. So let's say that this is Wednesday night right here. Or actually, this would be Tuesday night because that was Sunday night, Monday night, Tuesday night. Um, um, and let's say the market gets down to here. So now this is Tuesday. So let's just say that this is currently where we're at right here. Okay, well, that stinks again. So we're down on that trade from this would be like the opposite of the pound dollar because we shorted on pound dollar on Sunday and it just did not go in the right direction. So this would be kind of like that scenario where you get you take a sell and it just goes up all week. And then this one example, let's say that this one just goes against us all week. It's now Tuesday night or Wednesday night, and we come to here. So what we do is we again, number one, we don't panic because you're fine. You're just down on one singular trade. Meanwhile, you're doing this on like three or four other currency pairs, and you might be winning big on the other ones, right? So you're just kind of nurturing this one particular trade. Okay. Then what you do is you bring this back down, you readjust because these have not triggered yet. They're just sitting there. Okay. Now you bring these down and you do this whole process again. And you're like, okay, half an average daily range above this is 30 pips. So that puts me, yeah, about right there. We'll just go a little bit lower. And then we bring that buy stop back. Okay. And then we bring this other buy stop about 30 pips above that. And so something like that is where you'd put it. And then you'd go to bed and you reset and then you'd see what happens. And then if this finally comes back up, if this finally moves in your favor, you'll trip into those the next day and you'll start making money again. And here's the cool thing about it is if you trip into both of these buys and they just get about halfway up, you the combination of the loss that's now not losing as bad from this market order and the subsequent profits from these two down here, you'd probably be break even just on that setup, even though the market's down for the week. So you just needed a little bit of a blip to the upside. That's all you needed, just a little blip to the upside to recover this loser right here. Okay. And here's what happens too. Like let's say the rest of the week, into Thursday and Friday, this just goes straight up. Well, great. Now you're making money on this buy market. You're making money on these buy stops. Everything's happy again. Even though it just detoured throughout the week, it wasn't like this linear move. The market still went in the direction we thought it was going to go. It just took until the end of the week to get there. See, that's the thing about some of these weekly trades is like sometimes they go against you on Sunday night, Monday, Tuesday, and then Wednesday. Like that actually happened. I woke up on Monday. I was down. Tuesday, I was down on these weekly trades. We're now having a good week on the weekly trades, right? Like, and we didn't even do this. Like, imagine if you had done this on the weekly trades, you could exponentialize your profits on the weekly trades. Those are finally making money now, right? Um, which is awesome. And we did have a loser. The pound dollar hit the full normal average daily range loss. That was a full loss. Um, we closed out that Aussie Kiwi early, which I think that was a good decision to get out of, like we did yesterday. And then the other ones, we booked half our positions on those this morning because they were up. So, we're actually having a good week, which is awesome. But imagine doing this on those. Anyway, I'm gonna culminate this here in a second, but I'm not done yet. Need to give you another scenario. So this is kind of like the ideal perfect world scenario, which does happen often. So the perfect world scenario does happen. So be excited because that does happen plenty of times. Like that happened this week pretty much on the Aussie dollar. It was basically a perfect world scenario, and it did in fact happen. So, we obviously talk about worst case scenarios, and we're going to get to the worst case scenarios here in just a moment. But the perfect world does happen, and enjoy them when they do because it does happen. So this scenario that we just covered right here is your like good scenario, but it's not your perfect world one. Like it actually worked out because ultimately, even though the market went down for 2 days, you still got to move back up and you still made your money on the way back up. So this is a very unique and pretty cool technique. It's a risk management technique. So long as you adjust this every day, you can actually make quite a bit of money doing this. So this is probably the scenario that happens, I would say, most often. Some variation of what I just showed you here. This is going to happen most of the time, is like a not so perfect move to the upside or downside that ultimately goes in the direction you wanted, but it takes some nursing to get there. Okay. Now let me show you a couple scenarios um, that don't work out the way that you hope. So I just showed you those two. Let's do like a nightmare scenario. Okay. And what do you do in those nightmare scenarios? Okay. So I'm going to show you the rules for that because that also happens, right? Okay. So let's go through the couple scenarios that are not fun. Um, okay. So let's go back to Sunday here and I'm going to put these back. So, and I'm going to delete Tuesday night and I'm going to delete Monday night. Let's go back to Sunday night. Okay. Let's put these buy stops back to where they were originally. Okay. Okay. So this is what it would look like probably on Sunday night, is something like this. Okay. Let's say Monday rolls around while you're sleeping and you take these, Sunday night happens and the market goes up and you're happy. You're like, oh, great, this is going up. But while you're sleeping, it goes up. It triggers into all three of these and then this happens. Okay. That happens sometimes. Okay. So like you'll trigger into all three of those buys and it was going in the right direction until it didn't. Like it goes up and then it actually just comes down. Okay. So this is not a fun thing to talk about, but if you do it right, there's a way around this. So you wake up the next day and it's down like this. The first thing that you do is one, you don't panic, right? Because hopefully we've done enough with our lot size calculation and everything that this is not something I would really worry about too much. I'm going to get into how we do that as well. But that's the first thing we do is we don't panic because we should always be doing enough. Our lot sizing should be good that even if that happened, you should be okay. Um, but that's the first thing. You don't want to panic in those situations because then you make irrational decisions, right? So what's the next plan when this happens? Okay. So this is where we get to Monday night. So let's say Monday night rolls around and you're not a happy camper because this scenario took place where the all three buys triggered and then they went in the wrong direction. Okay. So what I do is I have to put a cap on how many trades I'm willing to take. So this is how you protect yourself. So um, does anybody know what I do when this type of thing happens? Like where when you use the modified martingale? Does anybody want to take a stab at it? What's my max amount of trades? Does anybody who's some of you guys have been you old timers? How many trades do I take with this modified martingale? Like what's the max amount that I do? Anybody want to take a stab at it? Yeah. Yep, you got it. Yep, both of those answers are good. So specifically, it's 5 to 6. And so yeah, Roger and Sean, you both got it. Yeah, so I do 5 to 6 trades max. Okay. So that's how many trades I'm willing to take per currency pair. All right. And then the general rule is that I won't use more than a 0.05 contract um on the 6 pairs per every $10,000 that I'm trading. Okay. So if I have $10,000, then the way I lot size this is a 0.05 contract per trade, up to 5 to 6 trades. So I guess up to six. So it'd be a total of like zero point 0.3. So yeah, like if you take 6 trades times 0.05, you're looking at a zero point 0.3 contract. Okay, so let me actually type these out. So I'm actually gonna put this right here. So this is a buy stop of 0.05, 0.5. Okay. And let me actually do that a few times. I'm gonna delete this. And I'm also gonna just add to this one. This was a 0.05. contract right there. Okay. Oh, there we go. Okay. And that's if I have like if my account equals $10,000. Okay. So if you had a and I'm gonna say 0.5 contract. And then I'm gonna also just highlight this. And then if like let's say you're trading a 100K account, that's gonna equal a 0.5, a 0.5, because that's 10 times more. Okay. All right. So that's kind of that's the general. You guys can change what you want to do, but that's what I've been doing. And it's worked pretty well as far as risk management goes. I haven't gotten myself into a lot of trouble. I've had losing trades for sure, but like I haven't gotten myself into a trouble with that. That's worked so far. But you guys, again, I'm not necessarily recommending that. This is what I've done. So you guys can decide, what you do. Oh, by the way, if you guys want to use this modified martingale, because it is a little bit more of a complex risk management technique, I highly suggest that you use it in a demo account for 2 to 3 weeks, maybe a month, just to see the perfect scenario trades, what those are like. I want you to see the not so perfect scenarios, and I want you to learn how to recover those trades. And then I want to see you have like absolutely bad trades happen and see how you recover those too. Okay. So, I need you to kind of see all different angles of what this is like. Okay, so let's continue on here. So that's kind of what I've done generally for my risk management. Okay, and then I'll go up to 6 trades. So now let's say we get to Monday. Obviously, we're not really happy with this. Hopefully, we've had some other good trades that have really worked out and we're making some pretty good money on those. So the next thing that I do is I actually continue. I just continue to place these up to the 6 trades. So I'll come in here and um, I will, oh, by the way, yeah, for stop losses. So what I've done is I've actually done with the modified martingale because I give the market more room. What I've done is actually 2x the ADR. Okay, so every trade has a 2x ADR. That is more than the weekly trades. I get it, but the whole point with this is to recover. So my hard stop on every trade is a 2x ADR. And I typically don't take every single weekly trade with this. Like I'll try to pick like my top 2 or 3 favorite trades of the week, and I'll just modify martingale those 3 or 4 trades or whatever. Um, 2 or 3 maybe. Um, so I won't try to go too heavy on a lot of different pairs. Although you're welcome to, I've tried to keep it like to because it gets too complex each night. You're adjusting way too many trades if you go with like, 5 different orders or 5 different currency pairs. Try to keep it to 2 or 3 of your top currency pairs. Maybe up to 3 would be fine because you're adjusting trades every night and it's really time consuming. So, oops, sorry guys. Let me forgot to turn off my phone. There we go. Okay, so yeah, that's what I would do. Yeah, and Roger says, okay, 2x stop orders are half ADR apart. That's correct. Yep. So write that down. ADR separation. So that's your spacing between each one. And then I suggest, and this is up to you if you want to do this, as I've done a full stop at 2x ADR. So if the stop loss or the ADR on the scanner says 61 pips, that means every single trade would have approximately like 122 pip stop loss would be the stop. The idea is not to use that because you should be able to recover most trades on your own using this technique. So there will be some times, and it has happened to me plenty of times, but there will be occasions where a trade is unrecoverable and you just can't get it to stink and go in your favor. and you have to have an exit plan for that. And so that's what I've done is just 2x ADR, and you just stop out. Okay. I used to do just an ADR, but then I realized that you're not giving yourself enough room to navigate this. The whole point of this is to recover. And so if you stop out at just an average daily range, there's really no point in using this technique. So you have to kind of give yourself a bigger playing field on the actual chart to work with to actually make this work. The other thing too is if a trade just flat out goes against you, likely you're not in all six trades. You're more than likely just in a couple of trades that hit their stop losses, and that's totally okay. Just to have a couple of trades just flat out lose. Um, because in all likelihood, maybe your other currency pair that's going on is going in your favor big time, and that should, in theory, make up for the loss of the one that just didn't work out. Um, Right. So that's where I'm bringing this whole thing together. So I want to show you guys. We're going to do I think Sean asked for a live example. Yeah, we're going to do two. I'm going to show you the perfect scenario, and I'm actually going to do all three. We're going to show you the perfect scenario, perfect world, the not so perfect world, but you make it work, and then the absolute gobsmack that did not work out scenario. Okay. We're going to do both, okay? Okay, so let's get to here. We're gonna finish the demo here, and then we'll do it in a live real quick. So I think you guys will like that. So okay, so right here you get to Monday, and this is not a good situation, but you got to continue. So what you would do is about 30 pips above this on Monday night, you're gonna place another buy stop right here. You're not buying right away. You're only buying if the market goes back up. So you're gonna place your buy stop there. And then you can go ahead and do it again. You can place another buy stop right there, pretty much where your original order was. Um, let me copy this, paste, and you should be able to put a buy stop right there. And then we do up to six trades. So that's one, two, three, four, five. So I could actually do one more trade right there. And then that would be it. Okay. So now you got three trades that have entered and you got three trades that are pending. Okay. So now if you get into Tuesday and the market goes back up, you can see how quickly you can recover all that, right? You can definitely recover all that. Okay. Now let's say that the market just continues down into this is now Tuesday night. So Tuesday night, the market just keeps going down, um, and you're in those three original trades that triggered. So now what you would do is you just bring these and readjust these, put them 30 pips, 30 pips above that is your spacing. And then you would replace these like this. And then, um, and then you would wait to see if the market would finally break up there. So you're down on those three trades um, that are originally placed from the weekend or from Sunday. And then these trades are waiting to trigger. And if the next day is finally a good day and you get that big move to up again, even if it's just to right there, you're making money because now these trades are close to break even or slightly losing, but then these ones are winning and now you're break even. So you could either just continue to hang on at that point, or you could choose to just flatten the orders and take your break even if you wanted to on Wednesday, or you could just leave it and see if it continues up. Okay. Now, let's say again, let me show you like, let's say that these three trades trigger and the next day the market just goes back down. Okay. This can happen. It has happened to me a few times. This is an absolute worst case scenario. Okay. Like, so I want you to know that this is not very common, but it's common enough that we have to talk about it. So, if this happens, I don't fight back anymore. Okay, like this doesn't happen very often, but if it does happen, like I just like I'm not gonna keep battling this trade. Okay, I had my opportunity to battle, I did my best, and it just didn't work. So what I end up I'll leave it open so long as they don't hit their stop losses. Okay, so maybe this just kind of navigates. I'm triggered into both. I'm losing money. The next day, since I'm in all three of these, I'm on all six. I don't keep adding because six is my cap. Okay, that's my cap. And then what I do is the next, if by Friday this finally comes back up, great. We're finally making money on that. But if it just continues to go down and your hard stop is, 121 pips or whatever, and if that's down here, then we'll go ahead and let the stop loss hit. And you will take a pretty decent hit on this trade, like you will lose some pretty good money. Um, this has happened to me a few times. Usually I've been able to mitigate it though. Like maybe I'll hit stop losses on these three, but then these three will break even, or I'll make just a little bit of money on these, and then these ones hit full losses. So I still lose on the entire setup, but it's not terrible. So that's happened to me a few times. But there have been a few times, like I will admit, where like it's just been a total like failure. Okay. And when it's a total failure like that, you just let it lose. Um, but it happens so infrequently that you'll have some other trades going on where the perfect scenario goes and you'll hit all your orders and the market just goes in your favor, that it's like no big deal. Okay. So I do have to share this because I'm overtly cautious. You guys probably have figured that out by now. I try to limit my liability as much as I can. That's why I'm showing you all the scary. And the scary does happen. So just know that it does. But that's why we put limits on these things. Okay. But so why do we do this? Like, even though that's kind of a scary thought of having six trades lose, the reason why we do this is because um, this provides a huge opportunity like to recover a trade that you believe in. Like if you believe in a stock or I do this in stocks a lot too. Like if there's a stock I believe in, I'll do the same thing. I won't add to it on the way down, but if it starts to rip back up, you can have those subsequent buy stops on the way up. I do this in crypto too. If you believe in something that you believe is in a bull market, and it goes against you for a week, you can layer those stop orders so that it, like today was a great day in crypto. I don't know if you guys saw it, but it's the same idea. Like crypto had like a bad week all week. And if you don't add to it on the way down, but what you do is you place those buy stops so that you're ready for it to rip back up. All of a sudden, just like you go from zero to absolute hero just overnight, right? With this type of thing. So, and what's cool about this too is that as the market's going against you, you're typically not losing a lot on the way down because you're not adding to it on the way down. You're only adding if the market goes in your favor. So that's the whole idea, is that you're only making money if it goes up. And if it doesn't go up in your favor, you just let it lose. So that's the whole point. Okay, so let's do some examples. So let me show you the perfect world example. This is one that I did today, or this week. We've been talking about the Aussie dollar. So obviously this is a trade that we've been talking about, that likely would be successful, um, for many reasons. We don't need to go into all of this, but at the beginning of the week, we had a hunch that this was going to go up. Um, let's pull up that weekend indicator. Here's the beginning of the week right here in this yellow area. So what you do is on Monday or Sunday, we come back to here and you place your market buy, okay, right there. And that's like I said, buy market, okay. And then just above that, 30 pips above that, you're going to place your buy stop. And I just do three. I do three orders just so everybody knows. I don't place more than three orders a night. So that's kind of another rule that I guess is important. It's just a preference. I don't think you have to do that, but I just don't want to trigger into more than three overnight is my max. Oh, this is sorry, I meant to say by stop order. Okay. I'm going to duplicate that. Oops. Copy, paste. There we go. Okay. And then 30 pips above that, you would place, let's see, 30 pips above that would be your buy stop order. Like right there-ish would be about where it would go. Okay, so now we fast forward, like we let the market do its thing. Okay, this is Sunday. First night, you trigger into one trade. This is actually going against me right there. You can see it triggered initially. went against me. Let's see. Can I stop this on where's Monday actually? So this is all Monday. Here's Tuesday right here. I guess that's Monday night. Okay, so on Monday night, I'd look at this and I'd be up on this original market order trade, but then I would trigger it in that buy stop and I'd be down slightly. So what I actually do is um, now that the market's here, I would actually move that buy stop, the one that's sitting up there, 30 pips above the current price of the market. So that would actually put this right there. Why 30 pips above? Because that's a half an average daily range. So that would go like right there on Tuesday night. And then you could actually place another order because, like I said, I'll place. You can actually place up to 3 trades a night is what I do. So you could place another order 30 pips above this, and you could do that again if you wanted to. But in this case, since we're really not down that much, I probably would just move that buy stop order a little bit closer in and see what happens the next day. Um, okay, so here's the next day. Let's see, where's Wednesday, or I guess Tuesday night. Tuesday night would be like right here. Okay. And okay, pause. I should have paused. Anyway, Tuesday night, that buy stop triggers. Now, since we're now making money on all 3 trades, I don't do anything. Okay. Since all 3 trades are making money, um, you don't need to place more trades. Like you could add another buy stop up here. I don't usually do that. If I'm in 3 trades and they're making money, don't touch it. Okay. Now, if I'm in 3 trades and they're down, yes, you'll add subsequent buy stops the next night. Okay. What happens? Well, this brings us to tonight. Let's bring us to the current place where we are now. This is today. So this is where you would basically be. You'd be in a buy market from Sunday and you'd have 2 buy stops that would have triggered along the way. That's it. Like but not only is that it, but like you're absolutely okay. You're making a crap load of money on this, right? Like this original trade is up a ton. This is a perfect world scenario. You're up big time on both of those. Like on every single trade, you're up on this one, you're up on this one, you're up on this one. And if you wanted to, you technically could continue to add, but like I said, I don't add. If all 3 trades have triggered from the original Sunday setup, I don't add anymore. Okay, it's just personal rule. Just because I don't want to over leverage something that's working. I do want to add into something that is working. That's the whole point, is to add to your winners, but you don't want to over leverage it. So all 3 of those would be in the money at the moment. Okay. Now, let me show you one. Okay, so think about this. This is one of this is like a trade that you take at the beginning of the week. Let's go find one that doesn't work well. Let's say you shorted the pound dollar at the beginning of this week. Okay, not a good trade, right? Not a good trade to start with. Okay, so here's what we do. Okay, so we come over here. Let's go back to the original. Um, let's go back to um, well, I guess here I'll go ahead and place this. So here's Sunday, and you'd place a sell market because if that's what the strategy called for, which it did, a sell on Sunday, you'd go ahead and place a sell right there. Okay. Then 30, or let's see, it's not 30 pips because the average daily range is different on this pair, right? So on the pound dollar, it's 88. So half of that's 44. So we would space these 44 pips apart. Okay, so 44 pips below this price right here would put you like right there-ish. Okay, so you'd go ahead and place a sell stop order down there. Sell stop. Okay, and then you do that again, about 44 pips below that, about there. And then there's that trade. Okay. So now you go like we could actually do a rewind. Let's do a rewind back to Sunday. So this is where you would be. This is what your trade setup would look like on Sunday night. And then inevitably, as you guys already know, this market goes against us. Let's get to Monday. Um, this would be about Monday night right here. Okay. And then you'd be like, oh shoot, I'm down on the sell market trade. So you have a chance right here to readjust this. Okay. So um, so now you'd be like, okay, so this is Monday night. I'm going to readjust these. So about 44 pips below this, I'm going to place, I'm going to replace this sell stop that's now pretty far away. I'm going to move it about 44 pips below this current price. Okay, so 44-ish pips would be like right there. Okay, and then that's where the sell stop would go. And then, um, and then I would place, I got to place this sell stop that's down here. I need to move it up a little bit, about 44 pips. So it would go like right there, about right there-ish. Okay. Oops, let's go right there. Okay, so now we got that sell market originally. It's currently down, and then we'd have this sell stop, and then this sell stop down here. Now we continue on. Okay, it does. Oh, actually, I don't know if it does. It looks like it gets close. We'll say it does. Okay, so that's fine. Um, just so that we can kind of go through the bad scenario, right? Okay, so now we get to the next night. Um, okay, so this is now like Tuesday night right here. So on Tuesday night, we're like, oh, this is terrible, right? Like, oh, this is not fun. We're losing money, okay? And I'll give it to you guys. So like, or I'll give it, just for the sake of explaining, right? Um, so here's the um so this trade, um, the sell market obviously is losing money, and then this sell stop, it may or may not have triggered, but we'll say it did. So you'd be losing money on that one. But this third one down here has not triggered yet. So what you would do is you would do the same thing again the next night. So say we're here on the next night, and you'd be like, okay, 44 pips is a half an average daily range. So 44 pips below that, we would put this sell stop order. So I'll go ahead and bring this up about there. And that's 44 pips below the current price. And then I'll put that sell stop, right there. And then now that we've triggered into two trades, I'm okay if you place another one. Like you could technically place another one about 44 pips below that. So you could go like, okay, 44 pips down here. That basically give you another trade around here-ish. And then you'd just have a sell stop ready to go down here. So you'd have kind of a cluster of trades all kind of in this area. Two of them have already triggered, right? In fact, can I change the color of this? I don't know if I can. Anyway, two of them triggered, these two have not. So now we fast forward to the next day. And then that brings us basically to today. Okay, so now we're down pretty decently. Like that's a good amount on two trades, but these sell stops down here have not triggered. So what would we do tonight? We would do the same thing all over again, right? So let's draw vertical lines. So here's tonight. And then we would say, okay, these two have not triggered yet, so I'm going to pull these away. Um, and we're going to go about 44 pips below um this current price. And we'd be like, okay, 44 pips below that. The current price of right now would put you like right here. And then that's where your first trade would go for tonight, right there. Then 44 pips below that would be the next trade. And you could go up to, like I said, you can place up to 6 trades if you want, and which we'd only have the two trades that are already in, and then these two pending orders, and you could place more if you wanted. Okay, and then you go 44 pips-ish below that, and then you'd place a sell stop right there. So you're in two trades that are losing, a decent amount of money. Like it's not fun. It's definitely not fun, but you're losing on two. And that's assuming this next one did trigger, and we're gonna assume that it did. And then you have these two that have not triggered yet. So now if we finally get a move down tonight on the pound dollar, then these guys will trigger and hopefully help us recover on these. But the idea is not to sell on the way up. Okay. That's the whole point. Do not add the sells on the way up. It's only if this market decides to break in our favor. If it breaks in our favor, we continue to work, we'll add to it. If this market goes into Thursday, tomorrow, and it just keeps going up, Say like fine. Okay. I hate it, but fine. Okay. Keep in mind, by the way, we do a 2x ADR stop loss on any of these trades. So these ones got to keep in mind, like their hard stops are, if the average daily range is 88 pips, then twice that would be like, what is that? 176. If I did my math right. Yeah, 176 would be twice that. So, um, it's possible that you actually lose on those two trades. Like because like this sell market currently would be down 168. So you'd be flirting with the stop loss. If you got into that sell stop down here, which didn't get a very good price at all, you'd be down. Yeah, you probably would have actually hit your stop on that. So you let those lose if they do. And then you could decide if you wanted to continue to place these sell stops or not, or you just take a hard stop on those two trades. Meanwhile, you have these things like the Aussie dollar making good money, like because this just went in the right direction. Okay, you'd have three trades just rolling in the right in your favor. You'd have trades like the Aussie franc that have also just gone in the right direction. We called those out very, very well, right? Um, those you can do those. Okay, let me get to some of your guys' questions here. I know I did a lot of explaining. I just wanted to make sure it was very clear what we're doing. Okay, Paul says, Steve, Euro Pound has been going against us. Did you use this technique on that pair? I actually did not do anything with the Euro Pound this week outside of just the weekly trade. I didn't do any modified martingale on this one. This is not one that I was like super confident with. I didn't post that as one of my trade ideas of the week, whereas like the Aussie dollar was one of my trade ideas. Um, this one I just took as just the normal like weekly trade. I didn't do anything special with this one, but you certainly could do that here if you wanted to. You could use that same technique if you wanted, but I didn't. So to answer your question, there you go. Sean says, you do this automatically for each pair or just one? No, I just kind of pick the ones that I really like, like if I do my analysis at the beginning of the week, I'll just do it with the ones that make a lot of sense. Um, you guys can do it with the weekly trades, but again, I've noticed if you do it with more than like three currency pairs, it gets confusing. So you kind of have to just narrow it down to like your top two or three and then just work that. Um, if you have like six or seven different trades going on, it's way too many trades to keep track of. Okay. And then also it says also if it's going against you, do you wait for the market to close, then measure the half ADR, or what time would you put in the stop orders? It really, that's a great question. It's when it works for you. You could do it in the morning, you could do it at night. I prefer the night when the market's slower. And so I set them up at night. So you could just pick a time every night and do that. Um, yeah, Muhammad says blew a few accounts adding to losing trades. Yes. Oh yeah. 100%. Yeah, we don't want to add to losing trades. We want to add to positions that start to go in our favor. So I will hold a losing trade so long as it's within our game plan. And then I will add to the losing trade so long as the market starts to curve back up. But if it doesn't, we're not adding. That's the whole, yeah, don't get in the habit of adding to losing stuff. It doesn't usually work, right? And the few times it does work, it's not enough profit to make up for the times when it doesn't work, right? You can lose yourself, you can get in trouble big time. So, all right, guys, I'm gonna go ahead and wrap up. We gotta take a break for Cot Report. But appreciate each one of you. Thank you for coming, and we will see you in the next webinar.